Hi there guys, Michael Beresford here from OpenCorp for today's wealth workout of the day. We've got a question in from a young guy, I assume, Michael, who had a question saying if you've managed to build an investment portfolio of 3 to 5 properties and you hit that magic 30 and you start to think about marriage and kids and so forth, how do you use that to be able to buy your your dream home, your principal place of residence for your family? Do you either use the equity that you've got in your investment portfolio, or do you sell some down to buy the home that way? So great question, Mike. We'll take you through that today. So let's assume that you've acquired some properties over, let's say, the last 5 years, for argument's sake, and let's say that you've got 4 of those, and they're all worth 500,000 today, which means your portfolio is worth 2 mil. Okay, to be able to do that, you're going to be about 80% LVR. So that's 1.6 million in debt. Okay, and that gets you. That's today. That's as we are right now. Now, if we have a look at holding these properties, let's say for another 5 years. And let's be really conservative and say that you don't buy any more properties in this time frame. You definitely could, but in that 5-year period, all of these properties are going to be well and truly cash flow positive and paying for themselves. Okay, so let's assume that this doubles by half, grows by half in a 5-year period. The properties will now be worth 3 million, those 4 combined, and you still have your debt of 1.6 million. Okay. Now, if you look at an 80% loan to value ratio, Mike, on that gives you 2.4 mil. So what we've got here, okay, is access to a significant amount of equity, being 800 grand, that can be used for the principal place of residence. Okay. Now, to be really clear, guys, this is going to come, whether you use the equity like this or whether you sell down to cover it, will depend on your borrowing capacity. It will depend on how much you want to spend on your own home, and it will depend on cash flow. Okay, so there are a few variables here that we can't foresee at this point, because to take this equity out, even though the equity is coming out of the investment portfolio, because the money is being used for personal purposes, the interest on this here is not tax deductible. Okay, so it's important to understand that. So you'd have a high level of debt on the principal place of residence. You just need to have the cash flow to support that if you're using equity. Okay. Now, if you don't have the cash flow to support it, all is not lost. At this point, each of the properties are going to be worth 750k. You'll incur some capital gains tax, some selling fees, etc., etc. You'll have to pay the loan out. Let's say that you've got 350,000 left in cold hard cash. Okay, sure, you'd only have 3 investment properties in your portfolio, so you'd lose a bit of the compound growth power over time, but again, this is about getting you what you want, and there's a pretty sizable deposit, which will mean that your mortgage is much lower when it comes time to buying your own home. So 2 options there. You can use equity, you can use cash. It'll depend on cash flow, it'll depend on what the properties are worth, and it'll depend on how much you're spending. But hopefully that's helped, and good luck buying your dream home when the time comes right.